Hello, this is Joe Hacker. I will help you to become a quant. You ask yourself how you can decrease the probability that you make mistakes in your spreadsheets. Well, you can use the top 10 financial modeling standards. How does that work? Well, here we go. Let's get started. You use the book Financial Modeling from Joachim Hecker and Dietmar Ernst. In the book, you have a look on the pages 7 to 58. And we start with step number 1, the top 10 financial modeling standards, as can be seen on page 24. We start with step number 1, define the modeling purpose. Well, what is the financial modeling purpose? We need to write down here the task and the aim. In our example, it is an M&A case, a merger and acquisition case. It's just fiction. It doesn't reflect reality. Novartis buys Pharma Group. We are mandated to advise the buyer, and our task is to carry out a valuation for and on behalf of the buyer, i.e. Novartis. Step number 2, separate the problem into independent subunits, i.e. modules. As you can see here under menu and documentation, different colors are given. The planning is done in green, the DCF valuation in orange, the multiples, trading and transaction multiples in red. However, here you see all the folders are green. So what we need to do is, for example, DCF valuation, we need to change the color and point out the color here, orange, like here tab color, orange, and here we go. So we change the color. So make sure you structure the entire Excel spreadsheet. Number 3, provide a graph of the flow of data and the model structure. Here under executive summary, you see here a graph of the flow of data. Our final result is the valuation range. We get that by putting 13 different results into the football field, that among these are number 1, the market cap, number 2, the book value, and number 3 to 8, all the different equity values based on trading multiples, and then another 5 equity value based on transaction multiples. And finally, last but not least, we also put in the result of the DCF valuation. So based on those 13 results, we come up with a valuation range. How do we get that? Well, number 1, the transaction multiples here are calculated clearly based on the given transaction. For the trading multiples, we get a peer group. We calculate the multiples, we calculate the underlying, we multiply the underlying with the peer group figures, and thereby getting our final result. For the DCF valuation, we need the risk-free rate that determines the WACC, also market risk premium. The beta is based on historic stock market index returns, and so on. So based on the WACC, we discount the forecasted free cash flows and come up with a so-called enterprise value, which we then transform to the market value of equity based on some iteration. Finally, we make some sensitivity tables, and it all goes into our DCF valuation. So you see, this is a clear graph of the flow of the model, and your model structure can be seen. Before you actually plug in numbers in your Excel spreadsheet, make sure you provide a graph of the flow. Next one, separate inputs from outputs? Well, if you have a look on the income statement, for example, and the income statement on the line E7, you see this is a plugin. You typed in manually 40 billion, 157 million. That is an input and output, and an input in an output is the so-called death sin of financial modeling. So what you want to avoid is commit the death sin of financial modeling. So there's a clear rule, the most important rule of the top 10 financial modeling standards is no inputs in an output sheet. However, you can have outputs in an input sheet if this makes sense according to the structure. Try to decrease the amount of outputs in an input sheet, but make sure you have no input in an output. So in this case, for example, avoid also like the cost of goods sold, or here the gross profit on sales. Here an input, this is a no-go. What you need to do is you link it to your assumption sheet. Next one, step number 5, choose a unified layout for the worksheet. So have a look at assets, for example. Here you start in the first row. You shouldn't do that. So always insert a row and then start not in the first column, in the first row. If you go on auxiliary calculations, here you go, and you check out the positions row 7 to 18, you see no colors are given. Here you always have gray pointing out an output. So what you need to change that and make sure a specific color, i.e. gray, is being given. And the same holds true for those rows. Next one, auxiliary calculation number 40. Here you see, usually we use column E to point out that this is the time T0. However, here it jumps. Suddenly T0 is pointed out in the column F. This is not so good because by knowing, when I click here on E, I know E that is based on T0. And if I click on this, I know D, something is not matching. Therefore, I need to grab the entire graph and move it. And now, in my formula, E, the column E is given. By having the formula E, I know exactly it points out T0. Next one, use unified formatting. Check out, for example, the cash flow statement in the spreadsheet that you downloaded, because the book comes with Excel spreadsheet, and Excel spreadsheet come with the book. So you can download the Excel spreadsheet on our webpage. And you see here in under cash flow statement, you see here there's a different formatting done. This also should be the same gray. So this needs to be the same here. And you see also that here the formatting is different than in those 3 columns. Like here always Times New York, here Times New Romans is being used, and here the size is only 8, and here you can see it's 10. So what you might want to do is make sure the same formatting in all the columns is being used. So if you go, for example, to cash flow calculation, you see here no outside and inside borders are being used. Here, always outside and inside borders, here not. So make sure that you have the same format and derive that with, for example, here outside borders. If you go to cost of capital, Here we go, cost of capital. Under E29, you see here many digits after the commas are pointed out. We don't want to do that. We want to have the same format. So you change that. For example, under DCF valuation, under row 16, you see here in the formula, a 1 is typed in. So these are mixed formulas that contain both fixed numerical values and formulas that should be kept characterized different. So here, for example, we should use the color green. Green points out that the different formulas are characterized different. So in this case, try to avoid any numbers in the formula. However, if you need to do it, like the numerator becomes 1, then you might want to indicate it with a different color. So let's go to step number 7. Avoid complex formulas and use only one type of formula. So if you go on cost of capital here and click on E42, you see here E42 points out a very complex formula. The WACC is calculated by taking the risk-free rate plus the beta times the market risk multiplied by the equity ratio plus the risk-free rate of return plus the premium minus the taxes times the debt ratio. That's a bit complex. Another way of doing and a smarter way of doing it would be you take the cost of equity, multiply it by the equity ratio plus the cost of debt and pensions after the taxes times the debt ratio. And here you go. See, same result. If you click on that formula, you see exactly the two components of the weighted average cost of capital, being equity and debt, neglecting any mezzanine structure. But this formula is clear. The probability that you make mistakes is clearly decreased. Number 8, avoid circular reference. For example, you click on auxiliary calculation E63, and you see here highlighted in yellow. The interest-bearing liabilities are based on the right side of the balance sheet, i.e. here the financial liability short and long term plus the pension provisions. So what I need to do is I just need to add those figures. However, in this case, it had been linked to the DCF valuation, because in the DCF valuation, I also need the interest-bearing liabilities when I go from the enterprise to the equity multiple, to the equity market value. So speaking about multiples, I also need the interest-bearing liabilities when I go to multiples. And when I want to go from the enterprise value to the equity value based on the trading and the transaction multiple, I use the same. So you see, I can link those figures also to trading and transaction multiple. Here I linked it back for the sake of simplicity to auxiliary calculation down there. And this one I linked to the interest-bearing liabilities. So this is actually a loop, a clear circular reference. And assume I'm having a rather complex spreadsheet where I have so many different methods. The interest-bearing liabilities are always core. You see here, this number is wrong. But because it is a circular reference, the wrong number is actually in my DCF, and the DCF is actually $1 billion too low. So what I need to do, I need to go on auxiliary calculation and say, okay, this is the sum of the 3 positions of the balance sheet as pointed out earlier. And you see here, there's a different number, the result. That number now goes into this position where I point out the difference between enterprise and equity value. And that I use now to link to my DCF. And when I go to the trading multiples, I don't go to the DCF or anything else. I actually always go back. I always go back to my position auxiliary calculation. So there, by doing so, I avoid circular references. Step number 9, work with control functions. If you click on equity and liabilities, for example, on position F48, you want to make sure that the right side and the left side of the balance sheet is balancing. So what I want to do is I want to check out what's the total assets in the first year of my business plan. Here, 53 billion. And I subtract the total equity and liabilities here, and I check out what's the difference. Well, the difference is 0. So the balance sheet is balancing. And I can point it out with a smarter way of doing it. I can, the spreadsheet tells me whether it's okay or whether there is a deviation. I also can check out whether my balance and my P&L are working and my business plan makes sense. So how do I do that? I check the cash position at the end of the year, of last year, and the cash position of the end of the first plan year. Here, in this case, it's 1,242,000,000. That needs to be equal the net cash flow, and the net cash flow is actually based on the operating cash flow, investing cash flow, and financing cash flow. So there's no difference. There's an okay. It's a clear okay. And my control function tells me I haven't done a mistake in the business plan. So the cash flow statement can be used to clarify and to verify my business plan. I can go further down the road and go on cash flow calculation and check my free cash flow. I calculated, for example, here in T3, I calculated taxes on EBIT. In the cash flow statement, I calculated taxes on the EBT. So how do I offset the difference? Well, I would say I click on income statements. So equals, open the bracket, income statement. I'll take EBIT, which is here, earnings before interest and taxes, minus the EBT, earnings before taxes, here. And I multiply that by going on my assumption folder and applying the appropriate tax rate, which I pointed out here in line 135, 24.3%, press return. So I can add now the tax gap. Now I also point out the investing cash flow in T3. And now I want to take my operating cash flow, my operating free cash flow, add the taxes between EBIT and EBT. And I also need to add the investing cash flow by doing now minus, and minus becomes plus. I press return. The result is 62991. And I have a look at my cash flow statement. Here, the cash flow statement, operating cash flow 6291. And the spread is 0. So I also controlled my P&L, balance sheet, cash flow statement, plus my DCF, and realized I haven't done any mistake here. So we go to Step number 10, present the results professionally. What I can do is I can go on my spreadsheet and say, hey, look, these are my final market values of equity. However, this is a bit, yeah, it's not really made for presenting that in a very good way. Therefore, I would like to apply a so-called football field. You see in the football field, the market value of equity based on the DCF is pointed out, the market cap, the book value, the different trading multiples, and the different transaction multiples. So what I've done here, I got different results, and now I need to come up with a conclusion. What is the valuation range? And that I put into my indicative offer. You can see, as pointed out at the beginning in my chart, so we use different input variables, and we came up with a result based on transaction multiples, trading multiples, DCF, book value, market cap. We put that in the football field, and now we derive the valuation range. And that valuation range is our final result. And that final result we can use now in order to go to the management of Novartis, the buyer, and tell them this is the amount, this is the precise valuation range they should put in the so-called indicative offer. Well, I hope you like the video. I hope it helps you to decrease the probability of making mistakes in your Excel file. If you want to proceed, just click in the links below, and we will help you to become a quant.